Good morning, participants. So we will now look at the second case study of financial asset at amortized cost. The first one we discussed in our last session. So the second one, case study on financial asset at amortized cost, we will look at. The facts of the case are given on your screen. On 1st of January 20X1, the company purchased a debt instrument for its fair value of 1,000. The debt instrument is due to mature on 31st December 20X5. So 5 years left for maturity. The instrument has a principal amount of 1,250 and the instrument carries fixed interest at 4.72%, which is paid annually. And the effective interest rate is 10%. So how should REV account for the debt instrument over the 5-year period? So how the debt instrument should be remeasured? Subsequent measurement. Initial measurement will be at the fair value 1,000. But subsequently how it is going to be measured at the end of each financial year, starting from 20X1 for 20X1, 20X2, 20X3, 20X4 and 20X5. How it is going to be? Subsequent measurements have to be made based on amortized cost and how the difference between two measurements will be transferred to the profit and loss account. So we look at the solution of this particular case study, how a debt instrument which has been purchased for a fair value of 1,000 with a 5-year term, the principal amount is 1,050, which will be paid on maturity, which will be received on maturity, that amount, and interest will be received at 4.272% each year. The effective interest rate is 10%, so you have to amortize using the effective interest rate of 10%. So let's look at the solution. So every year REV will receive interest of 59 on 1,250 at the rate of 4.72%. That is the principal amount of the debt is 1,250. So at the rate of 4.72%, the annual interest payment will be $59. And the principal amount, when the debt instrument matures, the principal amount also will be received, that is 1,250 when the instrument matures. So this is the cash flow from the debt instrument. Now REV has purchased this debt instrument at a discount of $250 because the principal amount of the debt instrument is 1,250 and the fair value paid is 1,000. So it has purchased it at a discount of 250. The discount has to be allocated over this period. So the REV must allocate the discount of 250 and the interest receivable over the 5-year term at a constant rate on the carrying amount of the debt. To do this, they must apply the effective interest rate of 10%. So the following table shows the allocation over this years. At the end of 20X1, during 20X1, the amortized cost at the beginning of the year is the fair value, that is 1,000, initial measurement of the debt instrument. Interest income for the year is 100 at the rate of 10% on 1,000. Interest received during the year on the instrument is 59. So 100 minus 59, that is 41, will be added to the amortized cost at the beginning of the year. So the amortized cost at the end of the year will be 1,041. This will be the amortized cost for the second year 20X2. So 1,041 is the amortized cost of the debt instrument at the beginning of the second year. effective interest at 10%, so the interest, that is interest income, that will be calculated on this amortized cost is 104. Interest actually received during the year will be cash inflow will be 59. So the difference, that is 104 minus 59, which is 45, will be added to the amortized cost at the beginning of the year. So the amortized cost at the end of the year will be 1086, second year. In the third year, the amortized cost at the beginning of the year is 1086, interest at 10% on 1086 is 109, 59 is the actual cash inflow, interest paid on the debt, received on the debt instrument, annual interest. So the difference is 50, it will be added to the amortized cost at the beginning of the third year. So the amortized cost at the end of the third year will be 1136. For the fourth year, at 10%, interest on this amortized cost of the debt instrument will be 113. 59 is the annual interest received on the debt instrument, so the difference 54 will be added to the amortized cost. The amortized cost becomes 1190. And in the fifth year, amortized cost at the beginning of the year is 1190. At 10% rate, interest on this is 119. The amount cash flow during the year will be 1050 plus 59. That is the principal amount plus interest for the fifth year. So the amortized cost at the end of the year will now become 0. That is how each year the carrying amount of the financial asset will be increased by the interest income for the year and reduced by the interest actually received during the year. So this is the working of the particular case study where a debt instrument, a financial asset has been purchased and it is measured, required to be measured at amortized cost. So Ritupavana, responding to your question now, we are now doing lesson 2, session 17, financial instruments. So this is the case study on the financial assets at amortized cost, second case study, which the first one we did earlier. I hope it is clear to you. Now we will look at another case study. This is on a financial asset fair value through profit and loss. The financial asset which is measured at fair value through profit and loss. The earlier two case studies we have done is basically financial asset at amortized cost. This is for a financial asset at fair value through profit and loss. We will also see if it is this example also, so you see a variation here as financial at fair value through other comprehensive income. So EBPLC purchased an equity investment for 30,000 plus 1% transaction cost on 1st January 2086. So EBPLC purchased an equity investment for 30,000 plus 1% transaction cost on 1st of January 2086. At the end of the financial year, 31st December 2086, the investment is revalued to its fair value of 40,000. So at the end of the year, the investment is revalued to its fair value of 40,000 on that particular date, that is 31st December 2086. On 11 December 2087, in the next year, the investment is sold for 50,000. So what will be the accounting treatment for this investment? This is a financial asset measured at fair value through profit and loss. If the preceding equity is instead classified as at the fair value through other comprehensive income, what will be the accounting treatment then? If instead of classifying that equity investment as an asset, financial asset at fair value through OCI instead of profit and loss account, what will be the accounting treatment? Let's also see that. So 30,000 is the fair value paid for the investment, 1% transaction cost. So for financial assets measured at fair value through profit and loss, the transaction cost, does it get added, capitalized or not? What is the treatment of the transaction cost? Is it expense to the profit and loss account, or is it added to the initial measurement of the fair value? So I am waiting for the response. This is a question to all of you. For a financial asset measured at fair value through profit and loss, what will be the treatment for transaction cost? Because here the transaction cost is involved, 1% of the fair value of the investment, that is 30,000, which is $300. So what kind of treatment we should provide for this $300? Should we add to the initial measurement of the financial asset, or should we expense it to the profit and loss account? So please respond on that. Yes, I am waiting for a response. So no response yet. Profit and loss account. Anybody else? Anybody else would like to say something different? Or all of you are agree with that it should be expense to the profit and loss account. Financial assets measured at fair value through profit and loss account, what will be the treatment for the transaction cost? Should it be capitalized? That means added to the initial measurement of the asset, or should it be charged to the profit and loss account in that year? So the treatment of transaction cost, if it relates to a financial asset or a financial liability at an amortized cost, then they are capitalized to the initial cost of financial or financial liability. If it relates to a financial asset or financial liability at a fair value through profit and loss, then they are written off in the profit and loss as an expense. So thank you, Rutiparna, for providing the correct answer. So this is the treatment of the transaction cost. It will be debited to the profit and loss account. It will be expense. Basically, it will be charged to an expense account, and through that expense account, ultimately it will get charged to the profit and loss account. So transaction cost, the treatment is, we have to be very clear about the transaction cost. Number one, relating to a financial asset, a financial liability at amortized cost, it will always be capitalized to the initial cost of the financial asset or the financial liability. If it relates to a financial asset or financial liability at a fair value through profit or loss, then they are written off in the profit and loss as an expense. It will be charged to the profit and loss account as an expense ultimately. So coming back to the case study now. So this 1% $300 will be charged to the whatever you call it, brokerage or transaction expense account. Some account will be debited and ultimately it will get charged to the profit and loss. So let's see what will be the accounting treatment for the subsequent measurement of the fair value of the asset on 31st December 2086 and subsequently when the asset is sold on 11 December 2087. So this is the solution for this particular case study. On 1st of January 2006, the investment will be recorded at cost at 30,000 and transaction cost of $300 will be expensed to profit and loss account. That is clear. This is the initial measurement of the financial asset. So the investment will be recorded at cost, which is $30,000, and transaction cost of $300 will be expensed to the profit and loss account. At the year end, that 31st December 2006 is the reporting date, the investment is revalued to its fair value of 40,000. So the gain of, since the investment is now subsequently measured at its fair value on 31st December 2006, the asset value will be 40,000 now, and the difference between the initial measurement and the subsequent measurement of the asset's value will be considered a gain. It will be credited to the profit and loss account. On 11 December 2007, when the asset is sold for 50,000, the journal entries will be like this: debit cash 50,000, credit investment 40,000, because investment was subsequently measured at 40,000. So investment account shows a debit balance of 40,000. So we'll credit investment account 40,000 and we'll credit profit or loss 10,000. So there will be profit and loss account will be credited with 10,000 when it is subsequently measured at 40,000, that is on 31st December 2006, and subsequently when the asset is sold on 11 December 2007 next year, then again profit and loss account will be created with 10,000, investment account will be created with 40,000 and cash will be debited with 50,000. This is for financial assets at fair value through profit and loss. But if the above equity was classified as at fair value through other comprehensive income, the accounting treatment will slightly change. On 1st of January 2006, the investment will be recorded at 30,300. Now the transaction cost will be added to the initial measurement of the financial asset. So investment will be recorded at 30,300. This is cost plus the capitalized transaction cost. So the transaction cost will not be charged to the profit and loss account. It will be added to the fair value of the investment, since it is a financial asset at fair value through other comprehensive income. On 31st December 2006, the investment will be revalued to its fair value of 40,000. So there is a gain of 9,700, which is 40,000 minus 30,300. This gain of 9,700 is included as other comprehensive income in the statement of comprehensive income for the year. So it will not be credited to the profit and loss account. It will be included as other comprehensive income in the statement of comprehensive income for the year. So it may be taken directly to a specific reserve in equity. So it will be held as a specific reserve as a component of the equity. On 11 December 2007, the journal entry to record the disposal of that investment will be debit cash 50,000, credit investment account 40,000, 300. 40,000 because now the investment account has been devalued at 40,000. So 40,000 and credit specific reserve account 10,000. So this is the journal entry to record the disposal of the investment. So if it is a financial asset at fair value through other comprehensive income, then the treatment will differ because then the transaction cost will be capitalized for the initial measurement of the asset's value. Subsequent measurement of the asset will be done at the fair value on 31st December 2006, 2006. And the difference will go to the specific reserve account, that is 9,700. And on disposal of the asset, the gain on the investment, that is another 10,000 from its loss, from its subsequent measurement of 31st December 2006 will be 10,000 will be treated also credited to the same specific reserve in equity. So that will be the treatment for the financial asset at fair value through other comprehensive income. I hope the example makes it quite clear regarding initial measurement of financial asset, subsequent measurement of financial asset, and how to profit and loss or gain from the investment or loss from the investment, how it is to be, what is the accounting treatment for that. Now we'll talk a little about derivatives. We will not go much into derivatives, but we'll just discuss derivatives a little for the purpose of our understanding of financial assets, accounting treatment for financial assets. Derivatives are basically financial products or contracts, we can call them. They derive their value from the underlying instrument. So for each derivative there is an underlying instrument or product. Like there can be a stock derivative where the underlying instrument is a particular company stock, shares. There can be index derivative where the underlying instrument can be a particular stock index. There can be foreign currency derivatives, US dollar or euro, where the underlying instrument is a currency. So derivatives are financial products or contracts whose value is derived from the underlying instrument. Generally derivatives don't require initial investment, or even if there is investment involved, it's a very small investment. Compared to the value of the contract, the initial investment can be zero or it can be very negligible, a small amount. And they are always settled. This type of contracts are always settled at a future date, over a future period of time in future or at a future date. So there are examples of derivatives are forward contracts, future contracts, options and swaps. So these are typical four kinds of derivatives which are available in the market: forward contracts, future contracts, options and swaps. All these are basically contracts which are to be settled in future. Forward contract basically is a tailor-made contract to buy or sell a specified amount of a specified item, a specified amount or quantity of a specified item, which is commodity or a financial item, on a specified date at a specified price. It doesn't require any initial outlay or investment. It has zero fair value at the date it is entered into. So initial measurement of a financial derivative like forward will be zero. Subsequent measurement may not be zero. Subsequent measurement can be different from zero, but the initial measurement of a derivative like a forward, that means the day the contract is entered into, is zero. because it doesn't require any initial outlay. Futures are also like forward contracts, very similar to forward contracts. Only thing here, they are standardized. Forward contracts are tailor-made, customized, but futures are basically standardized contracts in terms of the amount, date, currency, commodity, etc. And they can be traded on exchange. If a company holds future, it might be an asset or a liability at any particular date. A future contract held by a company can be a company's asset or can be company's liability depending on the value of the contract compared to its initial value. Compare based on whether the current value of the contract is more than the initial value or the current value of the contract is less than the initial value. That difference could be asset or liability for the entity. If the current value of the contract is more than the value of the contract when it was entered into, then there could be a gain for the person who bought the contract. So it could be an asset. On the other hand, if the current value of the contract is less than the value of the contract when it was purchased, then it could be a loss and it could be a liability for the holder of the contract. So if a company holds futures, it could be treated as an asset or liability as on a particular date. Swap is an agreement between parties to exchange cash flows related to an underlying obligation. So the parties agree to exchange their cash flows relating to the underlying obligation. The most common type of swap is an interest rate swap. In an interest rate swap, two parties agree to exchange interest payments on the same notional amount of principal at regular intervals over an agreed number of years. Again, swap is a sort of a tailor-made customized contract between two parties, just like forwards. And lastly, options. This kind of contracts, the holder of the option enters into a contract that gives us the right but not the obligation to buy. In case of call option, if he has purchased a call option contract, then the holder of the option contract has the right but not the obligation to buy. If he has purchased a put option contract, it has the right to sell but not the obligation to sell a specified amount of a specified commodity at a specified price. So these are the four kinds of contracts which we call derivatives, and we will be basically not discussing derivatives here much. We will be discussing about the accounting treatment for derivatives, and we will see an example also relating to accounting treatment for derivatives. So initial recognition and measurement of derivatives. The fair value of a forward arrangement like a forward contract, future and swap is usually zero on initial recognition. It is zero on initial recognition. The fair value is usually zero on initial recognition because they do not involve any outlay of funds. It may seem a little odd that a financial instruments which needs a recognized cost, a financial instrument whose fair value is zero at the initial measurement will need a recognized cost. Because if you are measuring initial measurement, you are making it zero, why should subsequent measurement, then why should we record it in the books? If financial asset or liability is zero, initial measurement is zero, then why it should be recorded in the books at all? But basically it is important to recognize these items in the accounting system because they are remeasured at the end of each reporting period. The initial measurement could be zero, but they need to be remeasured at the end of each reporting period. So that's why they should be on the, and when you remeasure them, the subsequent measured value of the financial instrument can be non-zero. Need not be zero. Initial measurement may be zero, but when you remeasure at the end of each accounting period, you may find that the subsequent measurement may produce a non-zero value. So that's why we should recognize them in our accounting system. So for the derivative contracts, initial measurement at fair value normally is 0 for most of the contracts except options. Subsequent measurement also has to be done at the fair value, and the difference between the initial measurement and subsequent measurement, if it is a gain, it will be credited to the profit and loss account. If it is a loss, it has to be charged to the profit and loss account. So the gain or loss will be transferred to the profit and loss account. So let's look at an example of a case study on derivatives. So ABPLC buys a call option on 1st of January 20X4. So when you buy a call option, you have to pay a premium. That's why initial measurement of a call option contract may not be 0, because the premium has to be paid. If the premium is capitalized, if it is added to the initial measurement or initial value, then the initial measurement may not be 0. So PLC buys a call option on 1st January 20X4 for $5 per option that gives the right to buy 100 shares of CDPLC on 31st December at a price of $10 per share. So it's a call option that ABPLC has purchased. They are the holder of the call option contract. They paid $5 per option, which gives the right to buy 100 shares in CDPLC on 31st December at a price of $10 per share. It's an option. So if ABPLC can exercise the option, it may not exercise the option. When it will exercise the option, very clear. It will exercise the option when ABPLC shares, market price of ABPLC shares is more than $10, they will exercise the option. If ABPLC shares are available in the market at $10 or below, then it doesn't give any benefit to the holder of this option contract to buy the shares at $10 per share under the option under that option contract. As long as the market price of the shares of CDPLC are more than $10, then there is an advantage for the holder of the contract. By exercising the option, he can buy the shares at $10 per shares and can sell it in the market at a higher price and make a profit. But if the shares are selling in the market at $10 or below, then there is no point in exercising the option to buy 100 shares of CDPLC at $10, because anyway it is available in the market at $10 or below. So there is no profit to be made by exercising the option. So that's why the option will not be exercised. The option will be out of money. It's a call option. $10 here is the price agreed. $10 per share is the strike price. So for the call option, it only exercised if the price of the underlying share, the underlying instrument here are shares of CDPLC. If the market price of CDPLC share is same as or below the strike price, then there is option is out of the money or at the money, and there is no benefit from the contract. So contract will not be exercised, it will lapse. So now how should the following transactions be accounted for in the given scenarios? First scenario is the options are sold on 1st July. Option which was first purchased on 1st January 20X4, paying $5 per option. The same option contract is sold by ABPLC on 1st July 20X4. This kind of contracts can be sold and purchased to the exchange. The options are sold on 1st July 20X4 for $15 each. So the holder of the contract he sells the contract. When he finds that the price of the contract itself has gone up, that means he can sell the option contract to another buyer by charging him $15. So this is one scenario. The second scenario is on 31st December, the person who holds the contract, ABPLC continues to hold that option contract. On 31st December 2004, when the contract is going to expire, on the expiry day, CDPLC share price is $8. And since CDPLC share price is less than the strike price, ABPLC lets the option lapse unexercised. So the option is allowed to lapse. It has not exercised. Third scenario is the option is exercised on 31st December when CDPLC share price is $25. The shares are classified as held for trading. So there are three scenarios. We are going to look at the accounting treatment in each of these three scenarios relating to a derivative transaction. Any question here? You are understanding that case study? Because we are now looking for the solution. We will be looking at the solution now for each of the three scenarios. In all scenarios, three scenarios I have discussed, the cost of the derivative on 1st January 20x6 is $500. That is the cost of the derivative or fair value of the derivative. Because when ABPLC purchased that option contract, they had to pay $5. The option price is always expressed in terms of per unit of the underlying. So there are 100 shares. The underlying for that option contract is 100 shares of CDPLC. So for each share of CDPLC, which is the underlying instrument here, $5 is the premium that has to be paid by the option holder for buying that contract. So $500 for 100 shares, which are that option contract, basically the underlying is the quantity or amount of the underlying is 100 shares. For each share, the option price is always quoted as per unit of the underlying. So $5 per share of CDPLC, there being 100 shares under the contract. So $500 is the amount which is paid by ABPLC for buying that option contract. See, in all scenarios, the cost of the derivatives on 1st January 20x6 is $500, and an asset will be recognized in the statement of financial position by debiting asset option $500 and crediting cash $500. So on the 1st January 20x6, the initial recognition of the financial asset will be as under debit asset option account $500 and credit cash $500. That is the initial recognition of this financial asset. Now we look at each of the three scenarios. First scenario is if the option is sold for $1,500. Remember, before the exercise date, ABPLC sold the option contract to another buyer, charging $15. That was the price it charged. The price of that option contract went up in the market, so ABPLC was able to sell that option contract, for which it paid $5 per unit of the underlying as premium. Now they could sell it to another buyer at $15 per unit of the underlying. So the option was sold for $1,500, $15 into 100 before the exercise date. So it will be recognized at a profit of $1,000. So $500 was paid for buying that contract and it was sold for $1,500. So the profit made is $1,000. You have to recognize the asset now in the books of ABPLC by creating profit and loss account. So debit cash $1,500, that is the amount received by selling the option contract before exercise. Credit asset option account $500 and credit profit and loss or income account $1,000. So that will be the accounting treatment, and the option is sold at a profit before the exercise of the exercise date. The same accounting treatment also will apply even if the option is sold at a loss before the exercise date. Only thing, instead of profit, we will have to now debit profit and loss account. Instead of crediting profit and loss account, we will debit profit and loss account. So if the option is sold before the expiry date, either at a profit or at a loss, this will be the accounting treatment. We will have to derecognize the asset. So cash will be received to the extent of the sale proceeds from the option contract, that is $1,500. Asset option account will be created with $500, that is the initial value of the asset as recorded, and profit and loss account will be created with 1000. That is if the option is sold before expiry. Scenario B, if the option lapses unexercised. Because on 31st December, CDPLC shares were priced, market price was $8 per share. The option gives ABPLC a right to buy 100 shares of CDPLC at $10. Since it is available in the market at a lower price, ABPLC will not exercise its rights under the option contract to buy the same shares at $10. It doesn't make sense. Something which is available in the market at a lower price, why should you buy it at a higher price under the contract? You have no obligation to buy, you have only rights to buy. So the option will lapse unexercised on the expiry date. That is second scenario. If the option lapses unexercised, then it will be derecognized again because the contract is no more valid. It will be derecognized and there is a loss to be taken in profit and loss. So we will basically debit loss account $500 and credit asset option 500 on the day of expiry of the option contract, 31st December. So that is when the option lapses unexercised, the asset has to be derecognized, so you have to credit asset account and debit loss account to that extent of the value of the asset. Third scenario, if the option is exercised, then also the asset should be derecognized. Once the option is exercised, the right to buy the CDPLC shares, that right is exercised, then also that you have already exercised the contract, so the asset should be derecognized at that point of time. Cash paid upon exercise, so you have to buy now CDPLC's shares $100 at 100 shares at $25. You will pay $10 because under the contract ABPLC will be able to buy, since they are exercising the right to buy at $10, so they will be actually paying $1,000 for buying those 100 shares of CDPLC by exercising the option. So the cash paid upon exercise and the investment in shares will be recognized at the fair value and immediate profit is recognized. So we will debit. The investment made is for 2,500, actual payment is 100 rupees, 1,000. Now ABPLC by exercising the option gets 100 shares of CDPLC. For that they have to pay 1,000 rupees, but the fair value of that investment is 2,500. So we will debit asset investment at the fair value of 2,500, credit cash, that is the amount to be paid upon exercise of the contract for buying the shares at $10 each, 100 shares, 1,000, credit asset option account because we have to recognize the asset which we created on 1st of January. So credit asset option account $500 and credit profit 1,000. So the profit made is actually 1,000. So this is how the accounting treatment will be done when the option is exercised on the expiry date. For exercising the option, actual amount to be paid by ABPLC will be 100 into 10, 100 shares of CDPLC at $10 each. So a cash account will be created with 1,000. The fair value of that investment that is created by buying 100 shares of CDPLC, the fair value is basically 2,500 because that is the market price of CDPLC share on the date of expiry. So we debit asset investment 2,500, we credit cash 1,000, we recognize the earlier asset option, so we credit asset option 500 and the balance amount 1,000 is the profit from this derivative transaction, so it will be credited to the profit account. So this will be the accounting treatment for derivatives. Derivatives can be treated as a financial asset, it can be treated also as a financial liability, depending on the type of derivative and also the value of the derivative compared to its initial value. So I hope it is clear to you. This example provides you 3 scenarios when the option contract, which scenario? Scenario C. Scenario C is basically on the expiry date of the option contract, CDPLC shares are selling in the market at $25 a share. Now, ABPLC has a right to buy under the option contract 100 shares of CDPLC at $10 per share. Something you have a right to buy at $10 which is selling in the market at $25. So it is to your advantage now. You can buy something at $10 which is available in the market or selling in the market at $25. Will you exercise or not exercise? You are right. You have no obligation to buy, but you have a right to buy. So you will be exercising because it is for your advantage. Something which is selling in the market price is $25, but under the contract you can buy it at $10. So you will exercise the right to buy under the contract, option contract. So ABPLC will exercise the right to buy under that option contract. So when they buy, the contract gets exercised, so the contract is no more. Once they exercise, the contract has no further value. Contract is over. After 31st December, the contract cannot be further recognized either as an asset or liability because its contract expires. So when they exercise the contract, after exercising the contract, the asset which was created, asset option, it has to be recognized. Number one, we cannot keep it in the books anymore. We have to recognize that particular asset. Now, how much ABPLC is paying for exercising the contract? ABPLC, how much they have to pay? 100 shares they will buy at $10 each. So they have to pay $1,000. For buying the 100 shares of CDPLC using the right available under the option contract, they will have to pay only $1,000. They will actually pay for an investment which is worth $2,500 based on the market price of CDPLC. So on that day, a new asset is created. When ABPLC exercises the right to buy 100 shares of CDPLC at $10 per share and buys those shares at $10 per share, 100 shares, they make a payment of $1,000 for an investment whose fair value is $2,500. Is that clear or not clear? Shubham Jindal, I am asking you this question. Now exercising your right to buy 100 shares of CDPLC at $10, you are making an investment in those shares. How much you are paying for the investment? Under the contract you are required to pay only $10 per share. So you pay $1,000. But what is the value of the investment? Fair value of the investment $2,500. That is CDPLC share price, $25 into 100. So you are, by exercising that option contract, you are creating an investment, new investment, a financial asset, but the earlier financial asset has to be recognized also. So that what will be the accounting treatment now? A new investment will be recognized, investment in shares of CDPLC, it's an investment. So the new asset will be recognized, asset investment. So how much is the value of that new asset? Initial measurement, $2,500, the fair value of the investment, that will be the initial measurement of that asset. So you debit asset investment $2,500. For making that investment, how much you have to pay under the option contract? $1,000. So credit cash $1,000. Then you have to also recognize the earlier financial asset which you created, asset option. So credit asset option $500 and the rest is your profit. That goes to the profit account. Is that clear or not? Shubham, I have explained it again, so tell me whether you have understood or not. Okay, thank you very much. Anybody has any question regarding this, please ask it. So, derecognition of financial assets. Under IAS 39, which we have been discussing, derecognition of a financial asset is appropriate if either one of these two criteria is met, one of these two, either the contractual rights to the cash flow of the financial asset have expired, or the financial asset has been transferred, for example, sold, and the transfer qualifies for derecognition, thus there is transfer of the risk and reverse of ownership of the financial asset. When the contractual rights to the cash flows of the financial assets have expired, or the financial asset has been transferred, that is sold, and the transfer qualifies for derecognition in the sense the transfer basically risk and reverse of the asset has been transferred to the buyer. So at that point of time, the financial asset should be derecognized. The first criterion for derecognition of a financial asset is usually easy to apply when when the contractual rights to cash flow has expired. The contractual rights to cash flow may expire, for instance, because a customer has paid off an obligation to the entity or an option held by the entity has expired worthless, like the earlier case. On 31st December, when the option expires, the asset has to be derecognized. Whether it is exercised or not, when the option contract expires on 31st December or a future contract expires on the expiry day, the asset has to be derecognized. So the contractual rights to the cash flows of the financial asset have expired. That is one condition. The other condition may be when the financial asset or the rights and ownership of the financial assets, risk and reverse of ownership of the financial asset got transferred to another person. Like the case of the derivative contract, we have seen the first scenario where the option contract has been sold by REV PLC at $15 on a subsequent date in July. So they purchased it for $500, they sold it at $1,500. So at this point of time, we have to derecognize the asset which we created when the option contract was purchased. In the second criteria, when an entity has sells or otherwise transfers a financial asset to another party, the transferor must evaluate the extent to which it has transferred the risk and rewards of ownership of the transferred financial asset to the other party. The evaluation is based on a comparison of the exposure to the variability in the amounts and timings of the net cash flows of the asset before and after the transfer of the asset. So basically, whether the risk and rewards of ownership have been transferred to the buyer or not. That is what we look at. Now we talk about financial liabilities and classification of financial liabilities under IFRS 9. The same classification applies for under IFRS 9 as also IAS 39. In case of financial assets, we have seen the classifications are different under IAS 39 and IFRS 9. IAS 39 provides for 4 classifications, whereas IFRS 9, which is going to be mandatory from 1st January of the next year, that provides for only 2 classifications of financial assets. But so far as financial liabilities are concerned, both IFRS 9 and IAS 39 provide the same classifications of financial liabilities. So the classification for financial liabilities are either it is one classification could be held for trading or speculative purposes. So upon initial recognition, it will be designated as fair value through profit and loss. Derivatives also are always measured at fair value through profit and loss. In all other cases, the financial liabilities are classified and measured at an amortized cost. So there are basically only 2 classifications for financial liabilities, measured at FVTPL, if either it is held for trading or speculative purpose, or upon initial recognition it is designated as FVTPL. Derivatives are always, remember, derivatives should be always measured at FVTPL. In all other cases, the financial liabilities are classified and measured at an amortized cost. The 2 approaches for classification of financial liabilities therefore are financial liabilities measured at fair value through profit and loss. Speculative purpose means you want to make a short-term profit. Speculation. Speculation is basically you are making. Basically, you are basically trying to make a short-term profit. Speculation is that when you are speculating on which direction market is going to move, prices are going to move, and then try to make a profit by buying financial assets or liabilities against so that you can make a profit from the price movement. Speculative purpose is basically when you try to guess, anticipate the direction of the movement, you are anticipating the movement direction of the prices, etc., and you want to make a profit by using that. Like somebody, if I'm anticipating that today if I'm anticipating that the price of a particular commodity or share may go up within next 1 week or 2 weeks, I can buy that commodity or the share, hold it, and when the prices go up, then sell it and make a profit. That is speculative. Okay. I hope it is clear to you. This is called speculation. Trading or speculative purpose are almost same. Traders are basically speculators. Some of the traders, not all traders. Trading and speculative very near, but some people just do speculation. They are not trading. Some traders are basically that's the business they are doing. It's a sort of trading business. Speculators may not be doing that particular business. I may not be doing. I'm not a commodity merchant, but I may be speculating in commodities. Whereas a commodity merchant is basically a trader in commodities. That is the difference. A commodity merchant, like say a person who sells grain, buys grain and sells grain, he's a grain merchant. But some other people, they may not be involved in buying and selling of grain directly. That is not their business. But they may buy future contracts in particular grains, expecting that the grain price will go up and they can make a profit. They are speculators. They are not traders. So there is some degree of difference between trading and speculating. So these are the two classifications for financial liabilities measured at fair value through profit and loss. Buying or selling of share is not always a speculation. It is the purpose for which you are doing it. See, buying or selling a shares can be an investment activity, can be a trading activity, can be a speculative activity. It all depends. A person can buy shares in the expectation that over a long period of time this company will show very good results and the company's share price will go up. He can make a substantial gain. This is an investor. This person is an investor. I buy, supposing say shares of HUTCO are going to be offered for sale. There will be offer for sale of HUTCO shares, Housing and Urban Development Company. They are going to issue shares to the public. The government is selling the shares, which are some of the shares which they are holding in HUTCO. They will be selling, offering to the public. Now this issue is going to come in next week. Now different people will look at this issue differently. Some people will think HUTCO is a very good long-term prospect. Over next 3 or 4 years, housing industry will get a lot of growth and HUTCO will benefit from the growth. So why not put some money in the HUTCO shares and wait for a long period of time? Let's see. We hope that the HUTCO will do well over a long period of time and we can gain the benefit by investing in HUTCO. This is one kind of motive with which people will invest. There will be people also who will be thinking that HUTCO shares are being offered at a very low price by the government. So when the shares are listed, they may be selling at a higher price in the market. So I can, if I buy the shares, if I apply for the shares and get some shares, and the moment the shares are listed, if they are listed at a higher price, I can make some profit and sell it. So he can be either a trader or he can be a speculator. Basically he is speculating. He has no interest in HUTCO. He is not bothered about how HUTCO is going to do in next 5 years. He is basically looking at the short-term prospect. Because the shares are offered apparently at a cheaper price by the government to the investors. So there is a possibility that when the shares are listed for trading in the stock exchange, they may be listed at a higher price than what he has to pay when he applies for the shares. So once it is listed, he can sell the shares which have been allotted to him and he can make a profit. So he is trying to speculate. He is expecting that the share price will be listed at a higher price than the offered price and he can make a profit. If he applies for the shares and gets some shares allotted in his name, then he can make a profit by selling the shares immediately. So he is a speculator. See, the question is basically the purpose for which you are putting your money. What is in your mind? So speculation, trading or investment are basically all may involve buying or selling of shares, but here the objectives are different. The objective of an investor, the objective of a speculator, the objective of a trader are completely different. But they may, all of them will either buy, sometimes they also sell, but they may be having different objectives. Is that clear? So positioning and classification of financial liabilities is same under IFRS 9 and IAS 39, and they are basically similar with respect to the. So there are two important categories of financial liabilities, as we mentioned: measured at fair value through profit and loss, and measured at amortized cost. So we'll discuss both of them. We'll see also a case study on financial liabilities, but we'll have a small break now, and after that we'll do that. So welcome back after the break. So the measurement of financial liabilities, there are two classifications, and how the financial liabilities will be measured. Initial measurement will be fair value, at fair value. For financial liabilities at fair value through profit and loss, the initial measurement will be only at fair value. Transaction cost will be expensed to the profit and loss account. It won't be capitalized. And for financial liabilities measured at amortized cost, fair value less transaction cost. It's a liability, so we'll have to reduce it by the transaction cost. So transaction cost will be capitalized. Subsequent measurement will be at fair value for financial liabilities which are measured at fair value to profit and loss. For the other financial liabilities which are measured at amortized cost, the subsequent measurement will be at amortized cost using effective interest method, which we have already seen in the case of financial assets at amortized cost. And the difference will be transferred to the profit and loss account. So more or less the same measurement principle applies here as in the case of financial assets under IFRS 9. So for financial liabilities measured at fair value to profit and loss, the initial measurement is at fair value, subsequent measurement also at fair value, and the difference will be transferred to profit and loss account. For other financial liabilities which are measured at amortized cost, the initial measurement will be fair value less transaction cost, and then is the amortized cost using the effective interest method, and difference again will be transferred to the profit and loss account. So we looked at a case study on a financial liability which is measured at amortized cost. The case study is on your screen. REV PLC raised finance on 1st January 20X1 by issue of 2-year deep discounted 2% bond with a nominal value of 10,000. Bonds are for a period of 2 years, maturity period is 2 years. Deep discounted 2% bond with a nominal value of 10,000 that is issued at a discount of 5% and is redeemable at a premium of 1,075. Issue cost can be ignored, so we are not taking into account transaction cost in this transaction. The bond has an effective rate of interest of 10%. So the bond is basically 2% bond. So interest payable on the bond is 2% of the principal amount. Nominal value is 10,000, so the interest payable is 2% of 10,000. So you want the last slide? Just a minute. Faisal wants the last slide, so I'll go back to the earlier slide, then come back. Faisal, tell me when you are done. Okay, thank you, Faisal. So I'll move to the next slide now, the case study. So this case study is for financial liability at amortized cost. The issuer is REV PLC. They issued a 2-year deep discount bond, 2% bond. That means bond carries a nominal pays interest of 2%. Nominal value is 10,000. So every year the interest paid is 2% of 10,000. That is 2,000. It is issued at a discount of 5% and is redeemable at a premium of 1,075. Premium, so the actual amount that will be paid to the bondholder will be 11,075 on redemption. Issue cost can be ignored. So transaction cost has not been taken into account. Transaction cost has been taken as 0. The bond has an effective rate of interest of 10%. So we'll see how it is measured initially on the date of issuance of the bond, and how it has to be subsequently measured, and what will happen to the difference between initial measurement and subsequent measurement. So EBPLC has a financial liability to be measured at amortized cost. It is initially recorded at the fair value of the consideration received, that is net profits of the issue. The amount will be then increased each year to redemption by interest added at the effective rate and reduced by the interest actually paid, with the result that the carrying amount at the end of the first year is amortized cost. EBPLC has no issue cost and the net profits are 10,000 less 5%. The bonds are issued at a discount of 5%. So actual issue proceeds from the bond is 10,000 minus 5%, that is 9,500. So the issue price of the bond is 9,500. It has been issued at a 5% discount. The annual cash payment is the 2% coupon rate on the nominal value of the date, that is 10,000 on 10,000, 2% is 200 rupees. So on 31/12/X1, that is the year in which the bond was issued, at the end of that reporting period, initial measurement was 9,500. Effective interest rate at 10% on 9,500 is 950. Interest paid to the bondholder is 200. So 9,500 plus 950 minus 200, that is 9,500 plus 750, that will be the amortized cost of the bond, 10,250 at the end of the first year. So that will also be the amortized cost for the second year. So on 31/12/X2, the second year, the amortized cost at the beginning of the year is 10,250, and effective interest rate of 10% on 10,250 is 1,025. Actual amount paid is 12,200. So and also the bond is redeemed at a premium of 1,075. So the bond is redeemed for a value of 11,075. So you can see the balance becomes zero. So the cash paid by way of interest is 200. 11,075 is the redemption value of the bond, because the bond is redeemable at a premium of 1,075. So 10,250 plus 1,025 gives you 11,275, which is same as the cash paid by way of interest and the redemption profits. So the balance is nil at the end of the second year when the redemption is made. So this is an example of a financial asset at amortized cost. So you know how to calculate the amortized cost using the effective interest rate method. So the initial measurement at the fair value of the consideration received, proceeds of the issue. Then the amount is increased each year to redemption by interest added at the effective rate and reduced by the interest actually paid. So the carrying amount at the end of the first year will be at amortized cost. That will be the carrying amount at the beginning of the second year, and then again we calculate the effective interest rate on the carrying amount for the second year. And then we look at the cash actual amount paid, 200 by way of interest and 11,075 by way of redemption of the bond. So the final value becomes zero. Is that clear to everyone? This is the example of a financial liability at amortized cost. Any questions on this solution given to you on the screen? If you have any questions, please ask it at this point of time before I move back the slides. Yes, Faisal Sheikh. What is the problem? What's not clear to you? I try to understand. See, the bond is for 10,000. Nominal value is 10,000. It has been issued at a discount of 5%. So what is 5% of 10,000? 500. So how much the bond issuer got when they issued the bond? How much consideration they received? They issued the bond of nominal value 10,000 and gave a discount of 500. So offered a discount of 500. So the bond was issued for 9,500. The bondholder has to pay 9,500 for getting those bonds. So the consideration received, fair value of the consideration received is the initial measurement. So the bond will be initially measured, the financial liability will be initially measured at 9,500. Okay. Now, using the effective interest method, that is effective interest rate is 10%. The amount payable on the bond is how much? On the amortized cost or the cost of the bond, 950. But actual interest paid to the bondholder in the first year is 200. So the difference between 950 and 200 will be added to get the amortized cost at the end of the first year. So 9,500 plus 750. That is the difference between 950 and 200. Interest on the bond at effective rate minus actual interest paid. So 950 minus 200, that is 750, will be added to the initial measurement to get the amortized cost at the end of the first year. So 9,500 plus 750 gives you 10,250. Is that clear, Faisal? First year's calculation, is it clear to you? How we arrived at the number 10,250? That is the amortized cost at the end of the first year. Now this amortized cost will be used again in the second year to calculate what is the interest on that bond. So 10% on 10,250 gives you 1,025. Bond is redeemed at the end of the second year. So the second year interest paid on the bond is again 200, 2% on the 10,000. And bond is redeemed at a premium of 1,075. So the bondholder gets 10,000 plus a premium of 1,075 on redemption. So 11,075 is paid to the bondholder on redemption. So the total cash paid in the second year is 200 by way of interest and 11,075 for redemption of the bond. Now the amortized cost of the bond at the beginning of the second year is 10,250 and the effective interest on that is 1,025, which adds up to 11,275. And it is same as the amount of cash paid by way of interest 200 plus redemption proceeds 11,075. So basically the value of the bond now becomes zero. When the interest is paid and the redemption proceeds are paid to the bondholder, the subsequent measurement of the bond's value will become zero. Is that clear? The second year's calculation. Thank you. So we'll now go back to the slide. So financial liabilities, when they should be recognized. We talked about the recognition of financial assets. Now we'll talk about the recognition of financial liabilities. A financial liability should be recognized when it is extinguished. When the liability gets extinguished, it should be recognized. It happens when the liability has been discharged, obligations have been discharged, or when it is cancelled or expires. So the recognition requirements for financial liabilities focus on whether the financial liability has been extinguished or not. This means that the recognition of a financial liability is appropriate when the obligation specified in the contract is either discharged or is cancelled or expires. Then a financial liability should be recognized. So when the liability or obligation specified in that particular contract is either discharged, like say the bond is redeemed, when the bond matures it is redeemed, so the liability and the interest is paid, so the contract is discharged, or it gets cancelled, or it is expires. So in one of these three events the liability is extinguished and the financial liability should be recognized. now we'll look at a small quiz. How will you classify the following cases as per IFRS? Customer's account with a bank. So you have to tell me whether it's a financial asset or financial liability. And secondly, whether it is measured at fair value through profit and loss or through amortized cost. Customer's account with a bank. How the bank is going to treat the customer's account? A deposit customers or savings bank account customers. How? What kind of, whether it's a financial asset or financial liability? First question. It's a financial liability. Is it at fair value through profit and loss or at amortized cost? Second question. What is the classification? Number one, it's a financial liability, fine. Customer's account with a bank. Now my next question is whether it's at fair value through profit and loss or it is at amortized cost. What should be the classification? Yes, very good. It is a financial liability at amortized cost. Loans and advances to customers by a bank. Is it a financial liability or a financial asset? Loans and advances to customers by a bank, whether it's a financial asset or a financial liability. When a bank is giving a loan to a customer, say a housing loan or a car loan, it's a financial asset, and again it's at fair value, it's at amortized cost. It is a financial asset at amortized cost. Deposits by a bank with a bank. Sometimes banks maintain accounts with another bank. The bank can maintain a current account with another bank. So the deposit made by a bank, or it can maintain a fixed deposit in another bank. So when a bank deposits money with another bank, it's a financial asset or a financial liability. And what will be the classification? When a bank gives money with another bank, whether it's a financial asset or a financial liability. First of all, whether it's a financial asset or a financial liability. Deposit by a bank with another bank is a financial asset, and it's a financial asset at amortized cost. Investment securities like debt instruments. Somebody has purchased debt instruments, so he has invested in investment securities, debt instruments, whether it's a financial asset or financial liability. A company has purchased some debentures or bonds, so they have made investment. These are investment securities, basically debt instruments, so whether it's a financial asset or a financial liability. And how these are classified. The investment securities, debt instruments are basically again financial assets measured at amortized cost. Trade receivables. Trade receivables in the balance sheet of a company, whether it should be considered a financial asset or a financial liability. Trade receivables. No response yet? What about trade receivables? Is it a financial asset or a financial liability? Trade receivables. It's a financial asset. Very good, Rituparna. And it is measured again at amortized cost. Investment in ordinary shares that are held for short-term speculation. If you are invested in ordinary shares, a company has invested in ordinary shares which are held for short-term speculation. These are financial assets and these are measured at fair value through profit and loss. So investments in ordinary shares that are held for a short-term speculation are financial assets which are measured at fair value through profit and loss. Investment in ordinary shares that from the outset are intended to be held for the long term. We are talking about IFRS 9. We are not talking about IAS 39. So we have only two kinds of classification for financial asset. One is financial assets at fair value through profit or loss, or financial assets at amortized cost. Or you can think of financial assets measured at fair value through other comprehensive income. So investment in ordinary shares that from the outset are intended to be held for long term will normally be considered as a financial asset measured at fair value through other comprehensive income, not amortization. Investment in ordinary shares that from the outset are intended to be held for the long term will be a financial asset measured at fair value through other comprehensive income. Next is ordinary shares issued. Ordinary shares issued are equity instruments. This will be considered as equity instruments. Debentures issued. Financial liability at amortized cost. Very good. Thank you, Shivam. And the last one, cumulative redeemable preference shares issued. This is not ordinary shares. Cumulative redeemable preference shares issued. That means these preference shares are eligible for a fixed dividend, which can be even accumulated. If the dividend is not paid out in a particular year, it will be accumulated. And these preference shares are redeemable at the end of a certain period. So cumulative redeemable preference shares issued also are financial liabilities. These are not equity instruments. These will be financial liabilities at amortized cost. Cumulative redeemable preference shares issued by a company will be considered a financial liability at amortized cost. But ordinary shares issued will be equity instruments. So IFRS versus US GAAP, so far as now we look at the difference between IFRS and US GAAP so far as financial instruments are concerned. One area is the available for sale financial assets, like say unlisted equity instrument. So we are looking at available for sale. This is one category under IAS 39, available for sale investments. So available for sale financial assets, unlisted equity instrument. Under IFRS, they will be measured at fair value except when the fair value cannot be reliably measured. Problem is for unlisted equity instruments, measuring the fair value can be sometimes very difficult. For a listed equity instruments, the market price is available, so you can always calculate can determine the fair value. But for unlisted equity instrument, it is difficult to determine sometimes the fair value in the absence of market data. So in IFRS, it is measured at a fair value normally, but except when the fair value cannot be reliably measured. Under US GAAP, it is generally carried at a cost except where a fair value option is selected. So this is one area. Second area is financial asset at amortized cost, effective interest rate. For amortization, what effective interest rate to apply? And under IFRS, an effective interest rate is generally based on the estimated cash flows, including future credit losses over the expected life of the asset. Under US GAAP, an effective interest rate generally is based on the contractual cash flows over the asset's contractual life. So somewhat similar here. So these are the points we discussed regarding US GAAP and IFRS so far as financial instruments are concerned. Two areas only. So in this session today, this is the last session on lesson 2, we will talk about hedging. So we will identify and conceptualize hedging, understand the various risks covered by hedging technique and the various examples of how hedging works. So IAS 39 contains special accounting principles for hedging activities. However, our discussion and objectives of the session under this course is to introduce and familiarize participants only with the hedging concept as covered in IAS 39. So we'll talk about the hedging concepts as covered under IAS 39, but we may not go into much details here. We have to just make you familiar with the concept. Now the question is, what is hedging? Hedging is a strategy or a technique designed to avoid risk or loss of a portfolio against volatility. So when you are holding a portfolio, the volatility may cause a loss. It subjects you to a certain risk. To avoid the risk of loss of a portfolio against volatility, hedging strategy or hedging techniques are used. So entities normally use derivatives to establish positions so that gains or losses from holding the positions in derivatives will offset the losses or gains on a related item that is being hedged. So we are talking of two things here: the item that is being hedged and the instrument that are used for hedging. So instruments are basically derivatives. So entities, they use the derivatives to take positions so that the gain or loss on the derivative positions will offset the losses or gains on a related item that is being hedged. The IAS 39 basically defines hedging as designating, that is, using one or more hedging instrument so that their change in a fair value is an offset to the change in a fair value or cash flows of the hedged items. So hedging is basically offsetting gain or losses from hedged items against the gains or losses of the hedged items. So we have got hedging items, we have got hedged items, hedging instruments and items which are being hedged. Like the value of the portfolio can be the hedged items, and the derivative contract, that is used futures or options, that could be the hedging instruments. So IAS 39 defines hedging as designating or using one or more hedging instruments so that the change in a fair value is an offset to the change in a fair value or cash flows of the hedged items. Hedging is essentially risk management technique that involves using one or more derivatives or other hedging instruments to offset changes in fair value or cash flows of one or more assets, liabilities or future transactions. So we are talking of two things. One is the hedging instrument, the other is the hedged item. The following figure represents the two important components required for hedging. There must be hedged item, there must be hedging instrument. A hedging relationship has two components. A hedging instrument, it's a derivative to be designated as a hedging instrument. The fair value or cash flows of the hedging instrument should be expected to offset changes in the fair value or cash flow of the hedged item. In addition, the hedging instrument must be with an external party. The hedging instrument, the contract must be entered with an external party. Hedged item is an asset or liability or commitment, firm commitment or highly probable forecast transaction or net investment in a foreign operation. To be designated as a hedged item, the designated hedged item should be expose the entity to risk of changes in fair value or future cash flows. So hedging is nothing but designating one or more hedging instruments so that their change in fair value is an offset to change in the fair value or cash flows of an hedged item. So let's look at an example to understand this thing. There is a US company whose currency is US dollar. The company produces and sells goods in Europe of worth 20 million euro. Invoice will become due for payment in 9 months. Whatever they have sold for 20 million euro, the payment for that invoice will become due in 9 months. However, the company is afraid that due to the fluctuation in currency rates, it will get lesser US dollar after 9 months when the amount is actually received. Because the amount will be received in euro, 20 million will be received after 9 months, and it has to be converted into US dollar. The company is afraid due to fluctuation in the currency rates, it will receive less US dollar after 9 months when the amount is received. So it is exposed to a risk. Thus the cash flow will be, it's a cash flow risk. Thus this US company enters into an offsetting foreign currency forward contract with a bank to sell 20 million euro for a fixed rate after 9 months. So the hedged item here is the cash flow from that export, that is 20 million euro, which is to be converted after 9 months to US dollar. And the hedging instrument is the foreign currency forward contract entered into by the US company with a bank to sell 20 million euro for a fixed rate after 9 months. There is a US company, so its currency US dollar. The company produces and sells goods in Europe of 20 million. Invoice will become due for payment in 9 months. However, the company is afraid that due to fluctuation in the currency rates, it will get lesser US dollar after 9 months when the amount is paid by the buyer. So the company enters into a foreign currency forward contract with a bank to sell 20 million euro for a fixed rate after 9 months. So that will ensure that the company will receive a fixed amount of US dollar no matter what happens to the foreign currency exchange rate between US dollar and euro. Company will get a certain number of US dollars by selling that 20 million euro to the bank at the agreed rate after 9 months. So this is the hedging. So the hedged instrument is the another example you can look at. Here there is a liability on the entity in France to pay 1 million US dollar in 6 months to the US entity. So we are looking at another example now. Here there is a liability on the entity in France to pay $1 million in 6 months to the US entity. The risk for the France entity is the value of US dollar will increase against euro. So the entity in the France can enter into a forward contract to buy $1 million US dollar in 6 months of time at a fixed exchange rate. So they are hedging against that risk. The risk for the France entity is the value of US dollar will increase against euro, in which case they have to pay more euro for making payment of 1 million US dollar to the US entity. So that is the risk. And hedging against that risk is done by buying a forward contract from a bank. It entitles the France entity to buy 1 million US dollar in 6 months of time at a fixed exchange rate. The exchange rate is decided at the time of buying the forward currency contract. At what exchange rate bank will sell 1 million US dollar, will sell 1 million US dollar to the France entity after 6 months is already decided, fixed already. Hedging item here is the payment commitment of a certain sum which has a risk of foreign exchange loss. That is the hedging item. That is that it, and thus it exposes the entity to risk of change of future cash flows. Hedging instrument which is forward contract to buy 1 million US dollar in the same period with the external agency, that is bank. This contract is expected to offset changes in the cash flow of the hedged item. Now there are different types of hedging relationship. Types of hedge we will talk about: fair value hedge, cash flow hedge, and hedge of net investments in a foreign entity. So a fair value hedge is a hedge of the exposure to changes in fair value of a recognized asset or liability on an unrecognized firm commitment that is attributable to a particular risk and that could affect profit or loss. Example, a hedge of the exposure to changes in the fair value of a fixed interest rate loan due to changes in the market interest rate, or hedge of the exposure to changes in the fair value of the inventories. Cash flow hedge is a hedge of the exposure to variability in cash flows that is attributable to a particular risk associated with a recognized asset or liability or a highly probable forecast transaction which could affect profit or loss example, a hedge of the foreign currency exposure associated with the liability as seen in the last example. This is the example of a cash flow hedge. And third is a net investment in foreign operation is the amount of the reporting entity's interest in the net assets of another entity, that is subsidiary, associate, joint venture or a branch of reporting entity. So these are the three kinds of hedge: fair value hedge, cash flow hedge, or hedge of the net investment in a foreign entity. Now, principles of hedge accounting is IS 39 guidance on principle of hedge accounting is derivative is designated as an hedging instrument. The hedge must be regularly assessed and found to be highly effective. So assessment of the hedge should be done periodically, regularly, and it should be found to be highly effective. Effectiveness can be reliably measured. And formal documentation must be prepared to describe the hedging instrument, hedged item, hedged risk, and testing effectiveness. So these are the IS 39 guidance regarding hedge accounting. So the derivative used should be designated as the hedging instrument. The hedge should be expected to be highly effective in achieving the offsetting changes in fair value of cash flows during the period for which the hedge is designated. The assessment should be regularly done throughout the period of hedging. Generally, a hedge is viewed as being highly effective if the actual results are within a range of 80% and 125%. Formal documentation must be prepared to describe the hedging instrument, hedged item, hedged risk, and testing effectiveness. So all this guidance must be followed in respect of hedging. So we have the IS 39 guidance, so we will not go into details or any case study here. So this completes your lesson 2. We will be starting lesson 3 from our next session. If you have any question, you can ask at this point of time. In the meantime, you can submit your feedback and I will be available for answering your questions after the feedback. So if you have any question, please ask it now. Otherwise, we'll end the session today. Okay, then we are closing the session. Apparently, you don't have any questions. Thank you.